This is Carlos, Dylan, Generation H. What's up, guys? We are going to first, before we get started, require for you to do a little little notification bell.
Subscribe guy.
Little subscribe guy, little comment, little. But today we're going to be talking about three of the primary different kinds of loans that people refinance or purchase rental properties into. We have conventional, we have debt service coverage loans, ratio loans, and we also have commercial type loans. So what we're going to do is oversimplify it, and we're going to have the pro column and the con column, and then we're going to go through each one of those so you guys can get what our perspective is on each one of those.
And these loans can be used as a purchase or on a refinance on the back end, by the way. Yep. You can use it for either of them. So let's start with conventional, which is what everyone's probably heard. It's probably the most known one out of all three, and it's what the most people use.
Those are like FHA, just...
Yeah.
Okay.
Basically, FHA is a little different, but it's similar to like standards of conventional.
Okay.
So with a conventional loan, you do get the best terms usually because you're on a fixed 30-year mortgage, which is the best term you can do, and you get a lower rate as well. And it's the lowest out of all three. So whenever you type in the 30-year fixed, what the 30-year fixed mortgage rate is, it'll usually be what you'd be getting as a conventional loan, assuming your credit is good. What are the cons, Carlos?
All right, so some of the cons is that you are limited to only 10 properties per person. So you have to be very mindful of that. So, and that's a Fannie Freddie rule. Now, if, say, Dylan was my partner and we both buy a house together, then that counts as one for each one of us. Unless I buy the house on my own, I can do 10. And if you buy 10 houses on your own, we can now have 20.
Okay, but so you and your wife could do 20.
So me and my wife can do 20, but we'll do it separate.
Yeah.
But if we buy all 10 houses together, that counts as 10 for both of us, and we're done. And that's all we can do. We're limited and capped to that. The other con is that you're limited to tax returns and W-2s. Although they do recognize like rental income, they do minus out a bunch of different operating expenses and factor a bunch of stuff in. So yeah, but you do need to have good, strong tax returns to prove that you can afford to buy this house, that you can pay for it, and then you also have to have a good W-2 job.
Now, you don't have to have both, actually, because I've actually gotten approved for conventional loans with just my tax returns, and I don't have a W-2 job, just for people that are worried if they want a conventional loan. Now, these were not for investment properties. They were for my personal residences, but
all right.
It is possible.
The other one that we primarily use and investors have now shifted to because they've become a more popular product is a debt service coverage ratio loan. And as you can see, it has a bit more pros and more cons. So some of the pros is that just like the conventional loan, it is a fixed loan. So you can do a 30-year fixed. It's not the rate's not going to vary. You're stuck for 30 years. You can do an unlimited amount of loans under this product. So you can buy 1,500 houses under your business name. So you can't do it under your personal name. It has to be under a business name. Okay. No personal income required. So again, because it's under your business's name, your business has to be generating some income. So they need to be able to see bank statements showing that you have a certain amount of money for coverage, for 6-month coverage, et cetera, but not under your personal. And then no tax returns are required. So that's completely out. Again, they're looking at the income of your business, not the tax returns of it. So what are some of the cons?
So the cons is you get a little higher rate than both of these doing the DSCR. It's probably about 2 points higher than the conventional and probably about another point higher than the commercial, which we'll go over in a second. You have to pay higher closing costs. Usually it's about 2 to 3 points, depending on how far you want to buy down the rate. I'm sure you can pay as much as 5 points if you want the lowest of the lowest rate, which nowadays is like 6.5% or something. If you were to pay 5 points to bring it down, it probably costs you 5 points to bring it down to a normal conventional rate. An asset must qualify. Now, what do we mean by that? It means there's a certain ratio, which we actually went in our last video. You'll see it. There's a certain ratio that these banks like to look for. If you're generating $1,200 in rent, they're not going to want to do a mortgage over $1,000 a month, basically, what that means. So you have to be renting it for a little bit more than the mortgage per month. And by the way, all three of these do require credit checks, so make sure you keep it on your credit.
Yeah. And I think the threshold for all of them is, what, 740? You have over 740,
740 is the
760.
best, I think. I think anything
Yeah.
over 740, you're getting the best rate possible.
Yeah, so keep that in mind as you're checking your credit when you're going to be refinancing. And then the last one that we have that's also very popular is the commercial loan.
Mm-hmm.
That's how a lot of investors got started. I think a lot of investor loans, or they finance their investment properties that way. What some of the pros are that they have lower closing costs because they're smaller. These commercial loans are generally credit unions that are very hyper focused on your community, your city. So they tend to be a little bit more flexible, with their constituents or with their people, right? Local investor friendly. Again, same thing going up. So you can go in, you can have a relationship with the person that's going to be underwriting it. You can have a relation, so they'll understand your investing style, or they'll understand that this asset's not quite the best. They can go in front of a board, sell your product, sell the house that you're going to be that you're looking to refinance, and they can vouch for you. This is a good investor. It might not be the best investment, and it's teetering, but like they can push it over the hump, opposed to like some bigger institutions. Even here, these are some bigger institutions. So those are two of the biggest pros, in my opinion.
Yeah, they'll pull strings for you, and they're easier to work with. I started with commercial loans. I still get them sometimes. It's a little harder to qualify for those than it is the DSCR loans. But the cons of them would be they're on an ARM and variable rate. What does that mean? That means ARM stands for adjustable rate mortgage. So every 5 years, sometimes they're 7 years, sometimes they're 3 years. Depends what you negotiate up front. Mine are on 5 years. It means every 5 years, the interest rate's going to jump to whatever the new interest rate is. So meaning if I got these 5 years ago and the interest rate was 4%, and now today interest rates are around 7 to 8, the ARM will actually push me up to 7%, so my payment will go up for the next 5 years. So it's fixed for 5 years at a time. It's still amortized over a 25-year period, so it still does get paid off over 25 years. It's just you have the risk of it increasing in payment during that. But it can also decrease in payment without you paying any refinance closing costs.
Now, sometimes there's balloons. So you have to you almost have to get like a new loan.
Yeah, sometimes there is balloons, but that's not what the ARM is. Balloons are negotiable. So yeah, if there is a balloon, you want to try and stay away from those because you're going to have to actually refinance and get a whole new loan to pay off the old loan, it's a lot easier just to do the ARMs or the variable rates. Tax returns, they do collect tax returns, so they'll be looking to see if you make it, how much income you made. It's a little harder to get approved in that regard because you do have to make a certain amount. I think your business has to have income for at least 2 years, I think they look at.
Yeah.
So you probably won't get much within the first year with commercial loans.
Unless your tax return, like your W-2s.
Yeah, unless you have a good W-2.
Yeah.
Exactly. And then the asset must qualify as well. Same thing as the DSCR loans. It has to rent for a certain amount over the mortgage in order for it to make sense to the bank.
All right. So those are the pros and the cons. Which one do you usually do?
So I've done all three, actually. The one I've been most recently doing is the DSCR because with the rising prices and values, along with the higher interest rates, it's a little easier to qualify and pull out a little more cash on the refinance when you get that good appraisal. That's why I've been using DSCR recently, and I think most people have. What about you?
Same thing. This is how I got started a long time ago. I was just putting my 20% down. When I became a full-time investor, I went to commercial loans because that was the most popular product for investment purchases. And then I've moved over to DSCRs, and by far, probably the easiest way to go about it. As long as the asset's performing, they're willing to give you a loan. And that's why it has the name debt service coverage ratio, because my asset is performing enough to be able to cover the debt on the property. So this is what I go with. This is what you go with primarily, but there are various reasons where you might choose different ones depending on where you stand at the moment. But these are the pros and the cons.
Yep. Well, if any questions you guys have, just throw it in the comments, and we'll try and answer them, or we'll make a video about them as well. Don't forget to subscribe, hit that like button for the YouTube algorithm.
Comment.
Yeah, comment. And I think that's about it.
That's about it.
Generation H.